We're always told to look at an investment's return, that one big percentage point that's supposed to tell the whole story. But here's the thing, that number, all by itself, it's just a tiny piece of the puzzle. Today, we're going to build a toolkit to look behind that number and really understand what makes an investment tick. So let's get right into it. So let me just throw this out there. Is a 10% return a good return? On the surface, it sounds amazing, right? But what if I told you it took 5 years to get it? Or what if inflation was running at 8% that year? And what if, to get that 10%, you had to ride a roller coaster of gut-wrenching ups and downs? All of a sudden, that simple number gets complicated. And that's exactly what we're going to unpack. All right, so first things first. Before we can do any of that, we need a simple, consistent way to measure our gain. This is the absolute foundation for everything else we're going to talk about. And that foundation is what we call the holding period return, or HPR. Just think of it as the total story of your investment in one number. From the day you bought it to the day you sold it, this calculation tells you the complete picture. And it's so important because it doesn't just look at the price change, it also includes any extra income you got along the way, like dividends. But here's where we hit our first snag with HPR. Time. I mean, if you hold one stock for 6 months and another for 2 years, their HPRs aren't really an apples-to-apples comparison, are they? We've got to find a way to standardize them. So which one's actually better? The 10% gain looks like the winner, of course, but it took 4 times as long to achieve. To make a truly fair comparison, we need to get them on a level playing field. We have to annualize them to see what each of those returns would look like if they were stretched or shrunk to fit a single year. And this leads us to 2 really important ideas, APR and EAR. Now, APR is simple interest, it's fine, but EAR, the effective annual rate, that's where the real power is. Why? Because it accounts for compounding, the magic of earning returns on your returns. That's why EAR gives you a much, much truer picture of your annual gain. When you're comparing investments, EAR is the number you want to focus on. Okay, so we've sorted out the problem of time, but there's this other kind of invisible force out there that can totally change what your returns are actually worth. And that force is inflation. I love this way of thinking about it. Inflation really is a silent tax. It doesn't show up on any statement, but it is constantly and quietly eating away at the purchasing power of your money. That 10% gain feels a whole lot different when the price of everything you buy has gone up by 8%. And this brings up a really, really important difference. The nominal return, that's the number you see on the screen. It's the growth rate of your money. But the real return, that's what truly matters. It's the growth rate of what you can actually go out and buy with that money once you factor in inflation. And luckily, there's a pretty simple way to get a good estimate. You just take your nominal return and subtract the inflation rate. What's left is your approximate real rate of return. So if your investment made 7%, but inflation was 3%, your real return, your actual increase in buying power, was only about 4%. So far, we've only been looking at one side of the coin, the return part. Now we've got to flip it over and talk about its inseparable partner, risk. And a great way to think about risk is as the price of admission you have to pay to even get a chance at those higher returns. So where does all this risk even come from? Well, it's pretty much everywhere. It can be the big picture stuff, like the entire economy going into a recession. It can be something that affects a whole industry, like a new technology that just makes the old way of doing things obsolete. Or it can be something that happens to just one specific company, like a product launch that totally flops. Uncertainty is just part of the game. It's one thing to say that investing is uncertain, but that's a little vague, right? How can we actually put a number on it? We need a tool to measure all that volatility. And our main tool for that job is called standard deviation. Now, don't let the name scare you. All it really does is measure how much an investment's returns tend to bounce around its average. A low standard deviation means you're in for a pretty smooth, predictable ride. A high number? Well, you better buckle up because you're in for a roller coaster with big ups and big downs. Now, if you're going to sign up for that roller coaster ride, you'd expect to get paid a little extra for it, wouldn't you? Well, that extra payment is called the risk premium. It's the bonus return you should expect for choosing a risky stock over something super, super safe, like a government T-bill. It's basically your compensation for being brave. Okay, so now we have a way to measure our reward and a way to measure our risk. But what if we could smash them together into one simple score, to see how much bang we're really getting for our risk-taking buck? Well, that's exactly what the Sharpe ratio does. It's a really elegant little formula that takes your risk premium, your reward for being brave, and divides it by the standard deviation, the roller coaster ride you had to endure. The result is a single number that tells you how well your investment paid you back for the risk you took. The higher the Sharpe ratio, the better. All right, we've built our toolkit. We know how to measure returns, adjust for time and inflation, and quantify risk. Now for the really fun part. Let's apply these tools to almost 100 years of market history and see what it tells us. Okay, first step, the reward. And just look at this chart. The story here is absolutely crystal clear. From 1927 to 2021, stocks delivered a powerful 12.17% on average. That just blows Treasury bonds and Treasury bills out of the water. On the return front, it's not even a contest. But that's only half the story, isn't it? And here is the other half, the risk. And would you look at that? The order is exactly the same. Stocks with those incredible returns also came with, by far, the highest volatility. T-bonds were in the middle for both risk and return, and T-bills were incredibly stable. The link is undeniable. So the big takeaway from nearly a century of data is this fundamental law of investing. If you want a shot at getting higher rewards, you have to be willing to accept higher risks. There's just no such thing as a free lunch. This trade-off is at the absolute heart of how markets work. And that, right there, is really the core message of this whole thing. Being a smart investor isn't about some secret trick to avoid risk, and it isn't about just blindly chasing the highest return. It's about deeply, truly understanding this trade-off and then finding the balance that's right for you. Look, history gives us an incredible roadmap. It shows us the rules of the game, but it is no guarantee of the future. So the real question isn't about what happened in the past. It's about what you do now. Now that you have this toolkit, now that you can see beyond that single headline number, how will you evaluate your next investment?